Well, I will reward those that have jumped in on time, and we'll make a start. So just wanted to let you know that this is recorded, so you will get a copy of the recording. And if you're listening to it as a recorded version, you won't be able to put any live questions in. Obviously, pretty much a no-brainer, that one, but just thought I would add that in. So how to build a property portfolio. It comes in very many shapes and sizes, and I've seen numerous of them over the journey. And I wish to go into a bit more detail as to what options are available to us, and how to affect that. And I think that the main thing is it really starts with you and understanding who you are and understanding what's in your control and what's out of your control. Because I think too many of us really concentrate on things outside of our control, interest rates, the market growth, vacancy rates, and yes, we can factor those things in, but it shouldn't stop us from investing and improving our wealth in general. So just wanted to start with that sort of pre-framer, I suppose. All right, so disclaimer, information only, no personal advice. But yeah, obviously seek professional advice or individual personalised advice more so if you're wanting to move forward in any way, shape or form. Like any good free webinar, I'll have a good old sales pitch towards the end. So if you don't want to hang around for that, that's cool. But there will be some pretty cool offers that haven't been done before. So you'll be hot off the press having access to those, and get your mobile phones ready because I've got a few QR codes up my good old sleeve. So thank you from wherever you're coming from tonight, in many parts of maybe Australia and potentially overseas. But I think most of you would know us from the My Millennial Property or My Millennial Money podcast. But if you don't know who the hell I am, a quick backstory. Grew up in a farm in country Victoria. Hard work was basically the motto, and success will follow that. That was the general gist of things as a child. For me, didn't really worry about too much. Had a great childhood. Didn't have a lot of money, but I know that I was happy, and I think it was a very different version to what childhood is today, which is the internet first and foremost, and screen time and more sedate activities, whereas it was totally the opposite for us growing up. 25 years in property investing. It's actually 24, but I thought I'd round it to 25, across 4 states. So had the ability to personally invest in those states give me a really good understanding of those locations and also the rules and regulations which come with state bodies, in particular to real estate investing. So why property for me? I think the big one early on, it was my uncle that influenced me on this. He was a bank manager in the local town, and he always said to me, look, the 2 most common wealthiest people that walk through the bank and have meetings with him are farmers or landowners, should I say, and business owners. So for me, I wasn't interested in the farm, so it was about, okay, how can I get my head around this property thing and get myself some land in other formats? And real estate really resonated with me. And I think this is important factor. Number 1 is do something that you're interested in and you're passionate about and you can understand it. You don't want to invest in something that you don't get, you don't understand. For me, it was just simply everyone needs a house. They need it to either live in as a rental or as a tenant, or to own, because that's the great Aussie dream. So for me, if I'm buying something that everyone wants, then that's got to be a good start. I just couldn't get my head around the whole shares and owning part shares in a company. I don't know what the board level decisions are making and who's getting fired and who's quitting and who's selling their shares at a board level. And it just real estate really resonated with me from an early age, and the reinforcement, I suppose, from my uncle helped with that. So what I then did was I went and did a Bachelor of Education specialising in phys ed. I had a real passion for health and fitness and still do. But that gave me time to think about, well, how do we build wealth? That was really an interest. And Rich Dad Poor Dad and Cash Flow Quadrant and all those key books for me that I think are key books still today were very much part of my after hours activities and just making sure that I educated myself, and that was a key. Knowing that teaching wasn't probably for me, after about 2 minutes of doing it, I just wanted more of a challenge, and I suppose I had a little bit of an entrepreneurial mindset. But fast forward to I suppose the last 12 years of coaching for me, because I'd built a portfolio and done okay at it. I wasn't so it was all success and no heartache, very much a combination of both, but it gave me the knowledge to be able to impart onto other people. And that was also my passion, is to help and coach other people. So the qualifications are great, but I think the experience is the key part for me. And I want to have a team of people that are also experienced and have been around for some time. I don't want someone that's straight off the university degree and into the wide world. I want someone that's got some good runs on the board. So yeah, been doing that for basically 12 years now. Passions outside of work and business and helping people is AFL, very much so. The Bombers had a great win on the weekend. Any Bombers supporters, we're going all right. Ironman triathlons, I've managed to do, I think, 7 of those now. So that has taken up a lot of time, but it's very fulfilling. And family and friends is a real focus as well. 3 beautiful kids, 8, 10, no, sorry, get that right, 10, 12 and 14 million. So try to create a nice balance of life as much as I can as a business owner. And I think when I'm coaching clients, I definitely want to implore that onto them as well. It's not just about being heavy into one part of your life. Yes, Adam, go the Don. Okay, so enough about me, more about you. I think we've got to look at these high level questions and just make sure we've got answers to them before we delve deeper into property. And I did a workshop in Adelaide yesterday to a group of AFL footballers, and age between 18 and 22. A lot of them don't know what they're doing outside of footy or after footy. But the key thing I said to them was, let's work out what you want first before you go and jump on realestate.com, because that's commonly the first thing that people want to do when they say, yes, I'm going to buy a property or I'm going to invest in property, is jump on Domain or realestate.com. And it's actually the last thing that you want to do. And I'll show you what I mean by that as we go. So first of all, have we got any long-term goals, and what are they? What do we value in life? What life do we want to live? Are some key questions that we can ask ourselves. So a lot of us spend time on the next 12 months or 12 minutes, or not a lot spend time on 5 to 10 to 15-year goals. And it is hard to think that far in advance, but I encourage you to really think about, well, what will life look for me? What will life look like for me in 15 years? Okay. Now, when I first started out, again, a bit of foresight, a bit of planning, a bit of good people around me, a bit of knowledge, a bit of education meant that when I was, my first property was 99, so I was 22. So I was a late bloomer. But at 22, I knew that there'd be some stage in my 30s that I'd probably find someone that I want to marry, and we would then probably have kids. There was no exact dates or timeframes around that, but I knew that probably in about 10 years that might start to get a little bit more serious. Don't know who I was even with at the time, but that the key of thinking 10 years in advance allowed me to open my mindset up to a longer term wealth plan, as opposed to just this next property that I was about to buy, or this first property that I was going to buy. So spending some time on some long-term goals and focus them around what you enjoy, not just, I want 5 properties. Why do you want 5 properties? Property is just the tool. Property is just the wealth creating tool. We don't buy property because we love the feature of the property. We buy property to create wealth and what that wealth can give us. So think about those things that you want in your life. And that will change, of course, along the way. And that's why I say to people, check in every 12 months on your goals, check in every 12 months on your property portfolio, check in every 12 months on your numbers and your values and your equity and all those sort of things as well. Have you got a cash flow management plan? If you're coming from the My Millennial Money world, I'm preaching to the converted here, but it's pretty straightforward. We need to understand this because this is very much in our control. We need to know what we're saving on a monthly basis to be able to plan forward for deposits and buffers and everything else. Have you got an emergency buffer? Yeah, call it 3 months worth of cost to exist, call it 2 months, call it 6 months, whatever you're comfortable with. And how comfortable you do depends on the next question is what your risk profile is. So are you an 8 out of 10? Are you a 5 out of 10? How do you gauge yourself against others? How likely are you to jump into something that's high speculative? A good litmus test, I suppose, is if the bank said you can borrow $1 million, would you go and do that straight away? If the answer that's no, then you peg back to where your comfortable level sits, and that gives you an idea of what maybe your risk profile is in relation to property. Because you might want to jump out of an aeroplane, but not take the step to buy property. So it's our risk profile comes in very much different shapes and forms. So first-time investors, what do we need to get in order? Now, you may be sitting here as a first-time investor. We may already have our principal place of residence, or we may be an actual first-time property purchaser. Either way, we're going to invest for the first time. So what can we lend is probably the first question that I would ask, right? How much do we need? What's our deposit? What's the stamp duty going to be? Are we paying LMI? Am I in an occupation where the LMI might be waived? And then the general other costs of what it needs to get into property. So if we reverse engineer and say, right, I sit down with my mortgage broker, they say I can lend 600,000. I know I've got 100,000 of my own money. That means I'm probably going to be purchasing somewhere around 700 as a maximum amount when I factor in stamp duty and 10% deposit, etc. If I want a 20% deposit, then I need to bring that back to maybe around a 400,000 purchase because of that 20% deposit. So understanding what deposit you're comfortable with, what your stamp is in that particular state that you're in. And I just start with Victoria because it's the highest stamp duty amount. So if we know we've got that covered, we might not know the location yet, but let's cover off in Vic and we know that we've got the rest of the states covered in terms of stamp duty costs. Am I using cash or equity? So for a first-time investor that hasn't got property at all, they have to use cash. You can't use equity from something you don't have, right? So you have to use cash as a deposit. But if you've got your own home and you know there's equity in there, and it's a quick calculation, it's the value of the property times 80% minus your debt is your usable equity, generally speaking, okay? So you can work out how much equity you've got in there, and then there's the bank's jobs or the broker's job to say, how much can you actually lend over and above that equity? We release that equity out and then away we go. And I'll show you a diagram of that tonight as well. We need to think about our principal place of residence, when, what, and where. Now, again, go back to 1999. Some of you might not have been born, but that was when I first bought my property, my investment property. 64,000 renting for $100 a week, and it cost me $6,000 of deposits to get in, and I missed the first homeowner's stamp duty concession, so I had to pay stamp duty on 64 grand, which wasn't much. But in any case, that was my first dipping toes into investing. Now, I had an idea, or I had a plan, sorry, that I didn't want my principal place of residence for at least another 10 years. Going back to those goals, I had a strategy that said, I'm going to build a portfolio, call it 2 properties, call it 5 properties, the number is irrelevant, but I knew for the next 10 years I was going to dedicate my wealth creation journey to investing in real estate, not buying my principal place of residence. Now, that's commonly today called rent vesting. And I love that concept, to be able to live where I wanted to live and invest where I thought was logic, right, in terms of creating the best outcome for my wealth. Now, that's not for everyone, and people want to live in their own home. And some of you may already be living in your own home, and that's fantastic. And that's why I said at the start, there's no one size fits all. If you haven't got your principal place, you've always got to be thinking, when is it going to be? What might it look like? And where might it be? And if we can get answers to those three, or a rough guide on what those three might be, then we can reverse engineer and say, okay, in today's dollars, it might cost me $1 million, and I'm going to need 200K because I want to put 20% down on my principal place of residence. Plus stamp duty, I probably need close to 300K. And if it's going to happen in 10 years, I need to save 30 grand a year. I'm going to build my portfolio using equity. If I can save more than 30 grand a year, then I can fast track building more property by putting some cash in as deposits along the way if I need to. So it's this cash versus equity game that we continue to play. But keeping your eye on the prize of that principal place of residence is extremely important, and arguably one of the most important questions we ask ourselves. Why? Because we go and buy 5 properties or build a portfolio where we've run out of servicing and we've run out of cash. And all of a sudden, we're married and we've got one on the way, or we have 2 kids on the ground, and you say to yourself, right, I want my principal place of residence next year. And you've got 5 properties and all your cash and everything tied up in your investments. What do you have to do? Well, you wait another 5 years and save more money, or you have to sell down your portfolio, which stunts the potential of what you built for in the first place. So we're always thinking about when our principal place of residence is coming. As I said, today, if you've already got one, then you don't need to put as much energy on that, but you're probably thinking, well, it's not my forever home. So it might be thinking about, when is that upgrade going to occur? So how do we get into the market? What's our risk profile and what's our lending? So go back to the $1 million question. Would I be happy spending $1 million, or can I lend $1 million from the bank, and then work our way back from there? Because going and buying real estate is quite easily. And I interviewed Eliza Owen, head of research at CoreLogic, last week, which will probably drop in the next few weeks for those listening to the podcast. And I think she mentioned a figure of around about 11 to 12 million homes or physical dwellings in Australia right now. So finding a property is the easy part, in essence, because there's so many of them available. But what works for us is the critical part. And I'll go through that 8-point strategy in a moment. We need to understand the property cycles that relate to this decision. So what's happened in the last 3 to 4 years? Well, we've had massive growth in a lot of areas. So very hard to pick and choose what areas to go into, because when you look at RP data CoreLogic, you'll see that that particular home might have doubled in the last 5 years. So am I buying someone else's profit? Or do I look at what's the historical growth been over a longer period of time? So asking ourselves a lot of questions in respect to the location. Are we borderless? Have we got the risk profile to say, I live in Western Australia, I'm only happy buying in Western Australia, and that's all. That's what keeps me sleeping at night. And if that's it, then that's fine. So that's what you stick to. But asking key questions of the particular locations in the West to be able to land on a particular market that's going to serve you well for the next 20 years, not just try and pick the market to get a discount now because it's a distressed sale, but all in all, it doesn't grow because it wasn't a type of dwelling in demand in the first place. Fear versus risk. So fear, false evidence appearing real, versus risk. What risk am I taking? What's the worst that can happen in your situation? And feel free to put in any, I suppose, things that you think you're worried about, or is a risk, or you have fear over, and I'll I'll try and combat them as best I can, because a lot of people say, well, I've got a fear that I won't be able to get a tenant. Right, so I can overcome that pretty easily. I can look at the last 20 years of historical vacancy rates, and then we can factor in what that average is going to be. So if it's 2% over the last 20 years, let's factor in 3 weeks of vacancies in our buffers and our cash flow, and all of a sudden we're covered. What if the tenant wrecks the joint and just goes crazy one night? Well, we've got insurance in place. We put building and landlord's insurance, and that covers that rent default or malicious damage or loss of rent or anything like that. So we've got insurance that will cover that. Yes, it'll be a headache and a bit of a pain at the time, but the property manager will do a lot of that heavy lifting for us as long as we've got those policies in place. What if I lose my job? What if I no longer have an income for the next month and I'm a single wage earner? I have no family. Okay, so that's a concern. But whether you have property or not, losing your job is the same effect. There's no money coming in. Now, I asked this question again yesterday to the workshop attendees. What's riskier, having your own home that you live in and losing your job, or having investment property and no home to live in and losing your job? Well, it's actually the first one. If you have a mortgage, you're the only one responsible for that. If you lose your job when you've got an investment property, the tenant is paying 80, 90, sometimes 100% of the running costs of that property. So it's actually riskier in Australia to have your own mortgage than it is to rent vest. Yes, you still need to pay the rent, but you've got options up your sleeve when you can no longer afford that particular rent. So you might write down here, what are some of the risks that you perceive? What are some of the fears that you have in your head? And just understanding how to combat those. And I don't think you ever sit there as an investor, well, I don't anyway, and say, well, I'm worried about this or I'm worried about that. There's always going to be some concern. And if there wasn't any, that's dangerous, because it means we're going and maybe buying something that we shouldn't, because we think it'll just be fine, right, without doing our proper research. So got a question, or sorry, just a fear. I'm a single income, and I'm reading this out, I hope that's okay. Fear, I'm a single income earner. Wife is stay-at-home mum, 2 children, 2 and 5. Well done. I own a principal place of residence, currently 500K loan balance. My fear is single income earner. I'm not saving enough. The majority of my earnings, about 43%, goes into repayments. Okay, so that is an extremely common situation at the moment. Now, the government says 30% and under, or anything over 30% of your income going towards your mortgage is considered mortgage stress. I don't naturally agree with that, because everyone's lifestyle decisions are different. How much discretionary income or spending, is going towards their life, how much their living actually costs, and how much they want to save. So I think you've got to look at your percentage and say, okay, yes, 43 goes to my mortgage, but I've got, when I last went to school, 57% that I'm spending to run the rest of my life. Now, some of that might be savings. It says I'm not saving enough, but what is enough? I'm not saving enough either, by the way. 57% to run my life plus my savings. So we're building up our buffers to a point where if we did lose our job, then we've got those buffers, okay? So there's no one size fits all here. Do we want to get a second job? Ideally, no. We've got 2 kids at home. Right? When is my partner going back to work? That needs to be established, and plan out the next 12 months to 2 years, as opposed to having just fear tonight and it's keeping you up. We've got to get some answers to it. Get out a pen and paper and plan this with your partner so that you can work your way through it and talk your way through it. And the more you talk about this, the more confidence you get. The less you talk about it, the more you bottle it up inside. Another one here, and then I'll move on. awesome questions, by the way, and fears, because this is a really common one. A friend advised against using the equity on your paid up home if you're not a high income earner, at least 350,000 for a couple per annum. Wow. Thoughts on that comment? Change friends, isn't it? No. No, keep your friend, but be careful where you get your advice and information from. They may be, well, friends and family have a very emotional buy-in to your life, right? And sometimes that can be a detriment to your wealth creation, because don't go and do that. It's not safe. What if you lose all your money, right? Whereas they're happy to advise someone that's not their friend to go and do the same thing. So using the equity on from your home, unless you save cash, is the only way that you can build a portfolio. Now, high income earner, 350K for a couple, I think is a small percentage of Australia. Well, I know it is, right? So if we're not reaching that, does that mean we can't go and buy property? No, absolutely not. Now, this might sound far-fetched, but I can guarantee it's not. I had a client on 65,000, and this was 10 years ago, so it is very different today. But they were able to buy one property every year for 3 years. So they had 3 properties and they're on 65,000 a year. So where there's a will, there's a way. That a massive mindset that said, I'm going to build a portfolio and my income's not going to hold me back. It might not be a tier 1 lender. It might be a tier 2 lender, but I'm going to get there and I'm going to adjust my strategy to suit my situation, meaning they need a high cash flow portfolio. And if you've got a fear around not being able to pay the bills, you need to adjust your strategy to have a higher cash flow, right? Extremely important. And yes, Annette, it would have made you worried because they are higher earners, which potentially means that you perceive them as more successful than you, right? Rightly or wrongly, that's what we do. So go back to basics and say, well, for my situation, can I go and buy property? Have I got equity? Have I got buffers in my life? Have I got a cash flow management plan? Have I got goals? Do I know what I want? Away I go, right? So I suppose, again, what I'm saying is we're never going to be 100% sure that it's going to work out, but we've got to do something because what we're doing here, we're not comfortable with, or we're not happy with, or content with, all right? Yeah, hope I may be able to come back to some of those, but they are unreal questions and observations around fear, because it is a common one, isn't it? All right, so let's look at the team of people that we need. So when we're building a portfolio, we need a great team of people, and we may sack our team of people. Just be prepared for that. And I'll give you examples of mine. So the primary team I think we need as investments specialists are our mortgage broker, our accountant, a conveyancer and lawyer, and they're 2 separate roles, by the way, and I'll expand on that, and a buyer's agent or a property coach. Now, they're not a non-negotiable, but if I was having my time again, I would fast-track my education, because it took me a long time, and I'm a slow learner maybe, to make the mistakes to then turn around and say, well, these are my actual non-negotiables when I invest in property. So I would fast track that. And you can fast track it by 8 to 10 years because of continually making different mistakes with not knowing enough about building a portfolio. Because ideally you want to get this done in 10 years and let your property portfolio do the working for the next 20 years after that. So the mortgage broker, extremely important. They need to be sophisticated. They need to understand that they're working with investment specialists that are building a portfolio, not just a mum and dad homeowner. Accountant, I've sacked my accountant twice. So that I'm on my 3rd accountant now, and I've had them now 10 years. So I'm loyal to someone who's doing what they need to be doing for me. But I had a situation there where I had a tax return that was, well, at the time was an 18K tax bill that I had to pay. I'm like, this doesn't sound right. I got properties, I run a business, etc., etc. Got a second opinion, and it actually turned out to be a 20K refund. So it was a 38K difference between my first accountant's tax return estimate and what is my now accountant. I've employed this accountant on the work that they did to estimate my return when I questioned it. So don't be comfortable with your team of people. Continually ask good questions, and you may need secondary advice at some stage. What's the difference between a conveyancer and a lawyer? Conveyancer will look over your contracts for you in the state that they're regulated to. A lawyer will write up any contracts that you need as a business owner. If you're not a business owner, don't worry. But you need wills and estate planning by a lawyer, a firm of specialists in that wills and estate planning space. So you would have a team of people. Now, for me, they're all under the one building. They've got conveyancers, they've got wills and estate planning, they've got lawyers, etc., etc. They specialise in different matters. So, yeah, getting all that done is extremely important because that protects the assets and sets it up in the right manner. And they'll also help with some entity choosing when you're buying property, or the good ones will anyway. And the secondary team of people, real estate agents, property managers, building and pest depreciation companies, insurance companies, etc. So I've got links to all those if you need them in certain areas. So if you need contacts in depreciation, insurance, etc., just sing out and we can get you some of those as well. Now, question just quickly, Eric. Difference with solicitor. Purchased all my properties in the past using this one solicitor that I got introduced when I first bought. Yes, so solicitors can operate in most parts of the country, whereas conveyancers are regulated in their particular state, or they need to apply to regulate in a particular state. So, yeah, solicitor has done more training at university and can cover more things. Conveyancer usually doesn't charge as much. So if you've got one solicitor that you're happy with the fee structure and does everything for you, then that's absolutely fine. I don't know if I can pronounce that. Surya. Apologies if that was incorrect. Thoughts on property ownership structure. Look, that's an accountant's job. Trust versus companies versus own name. I've purchased in all of them, and there's pros and cons based on asset protection, lending, how long you're holding the property, etc. So yeah, you get a good accountant in your corner, and they will be all over that. I will say, however, that a lot of accountants set up trusts and companies to buy property in when it was absolutely a complete waste of money. And people come to me and say, oh, I'm borrowing on lending in this trust structure. Why have you got a trust structure? Okay, my accountant advised me to, right? And we've got some issues with capital gains, or we've got issues with land tax, or we've got issues with lending. There's all sorts of sort of issues going on there, and it turns out in a lot of cases that it was a waste of money. So not saying that's for everything, but I do see it quite a lot. All right, so what can this look like? Now, hopefully you can see this pretty pink. It is our envisaged property colours, or one of them. So this is just a 3 properties in 10 years scenario. Now, some of you, that might freak you out. Some of it might be not enough. You want to get 5 in 5 years if you can. Now, 2 things stop you from stop you from taking action. One is lending and one is your risk profile. So provided you've got both of those, first property we may have purchased for 700K. We've got a loan amount of 400, okay? So we paid it down to 400 is probably what I'm saying there. Whether it's your principal place or not, doesn't really matter, but let's use it as your principal place for the minute. We've got an extra 50 grand sitting in the offset. So we're paying interest on 350,000. We don't want to use that 50 because that's offsetting bad debt because it's your principal place of residence. So we're taking out 100 of that paper value of that property of 700 on property 1. So our loan amount will be the 400 plus the 100. And we're taking that 100, of course, as equity, and we're going to buy property 2. And we're doing that in year 5. So we've paid down the mortgage for the last 5 years, and we're using some of the equity to go and buy our first investment property. And we're buying in at 500K. Our loan amount's 450, so we put in a 10% deposit. We're using 50K of that equity. We're using 20K for stamps. That's must be in Queensland, New South Wales, at that price. We might spend some money on a buyer's agent, some other associated costs, building and pest, etc., conveyancing, and we've also got a buffer up our sleeve. So there's our 100K used up, and away we go. Now, I'll get into the 8-point strategy soon, but understanding that that's the concept of it, right? Using the bank's money, 102 or 3% of it of the purchase price to go and buy that second property. Keeping cash heavy, building the offset account up to reduce the interest on your bad debt, and then away you go. Rinse and repeat as many times as you can because the banks keep lending you money. When the banks stop lending you money, you need to pivot and maybe sit on your hands for a while as you see fit. But I've looked at our third property in 10 years, a purchase price of 600K, same deal. We've taken out another 100K from property 1 because that's been in the system for 10 years, doing 10 years of heavy lifting. So generally that will have the most equity. Loan amounts 500K, deposit 60K. Actually, those numbers are slightly incorrect, but yeah, purchase price 600, loan amount should be 540. It's a deposit 60K, and we've got associated costs, stamp duty, etc., etc. So that's how it basically looks on paper. Now, the key there, we don't want to, and Eric's just asked the question, we don't want to have a cross-securitized setup. Now, how do we know if there is? And I suppose I'm presuming that you've got a level of knowledge here tonight. But if you need more info, just hit me up at some stage. But basically, one lender might have all 3 properties, but they need to be separate from each other. So they're taking the equity release and it's sitting there as a separate loan. So on property 2, you'd have 100K as one loan, and then you'd have the 450 as another loan. Property 3, you'd have the 100K as one loan and the 540 as the other loan. And then property 1, you might just have that one loan, right? Because you put in a cash deposit to begin with. So across 3 properties, you'd have 5 loans. If across 3 properties, you've only got 3 loans or 2 loans, there's a pretty good chance that it's cross-securitized. So ideally, you want to avoid that. Now, have I ever cross-securitized properties? Yes, I have, because I had an aggressive nature and I went hard on property at certain times in my life, and I knew that I had backup to be able to get me through with buffers and whatever else. But it is quite restrictive, and it can come back to bite you if you don't understand the ins and outs of it. Ivan says, no, sorry. Yeah, evening, John. Can you shed some light on finance structures like line of credit and multiple offset accounts? Any advantages over the other? Yeah, good question. So multiple offsets are fantastic. Someone like CBA has unlimited offsets, and I think that's amazing. You can go and put kids accounts, holiday accounts, bills accounts, whatever account you want, basically. You can have 10 offsets if you want. Essentially, they're all doing the same thing, totaled up to offset the interest on the bad debt in your principal place of residence. Okay. Yeah, line of credits. Yeah, we don't really use that term in investing property so much. It's more in businesses. You might take a line of credit as a loan and then use it to fund the running costs of your business. I know on the farm we had a line of credit and we draw that down to buy spray equipment, for example, or to put the crops in, and then you pay it back once you harvest. So it's more irregular income that where you need that line of credit. But ideally, you keep it pretty clean with properties. For the third property in the scenario, should you release equity if possible from the IP rather than the PPR? It's a good question, Cian. I think it's how I pronounce it. Yeah, you're giving me tough names to explain tonight. Hopefully I'm doing okay at it. The doesn't matter is the bottom line there in a lot of cases. The case where you'd think about it a little harder is which one do you think you'll be selling? Because if you're selling one of them and you've just taken equity to buy that next investment property, you have to pay back that equity when you sell that property because the equities come from that property, if that makes sense. So that's in a scenario where you wouldn't use that particular property. Now, whether it's your principal place or that investment, who knows at the time. But again, some forward planning, you'd allow the right decision there. But generally, you're taking equity from the property that's got the most equity in it, aren't you? So, and usually that's the one that you've held the longest. But if you're thinking about selling a property in the next couple of years, don't take the equity from that property, take it from another one that's got more equity and you're going to hold it for longer. All right. Some of you might have seen this, and I just threw it in because it's a bit of an educational learning piece, and it actually surprised the hell out of me. I took 7 suburbs, towns, over a period of time and analysed their capital growth on an annual basis, and the median house price, and their population, and their gross yield, and their vacancies. And I put it together and observed. Now, you may make your own observations of this, but all in all, let's start the right. The vacancy rates were low on all of them, so we were comfortable that we could go and invest there. The gross yield. Now, you look at Broken Hill, massive high gross yield, so cash flow positive property, no problems at all. We go to look at the growth, 1.7. 1.7% was the annual growth rate, pretty crappy. So cash flow strategy, fantastic. Growth strategy, terrible. Adam, what's a low vacancy rate? Look, anything under, I suppose, 2% is normal. Most places around Australia at the minute are 1% and under. If you've got a place that's 4% vacancy rate at the minute, I'd be concerned because of the low supply in Australia right now and the high demand for housing. And then you take somewhere like Jindabyne, 13.7 annual growth, fantastic, only a 3.9 gross yield. So we take Jindabyne every day of the week, but can we handle the cash flow? And I'm leading into my 8-point strategy in a minute. Can we handle the cash flow on that property when our gross yield's only 3.9%? That's what we need to get right, because the 13.7% means nothing if we can't hold it because we have to sell it too quickly because we couldn't handle the cash flow, we didn't do the numbers. But look at the population, 4,300 people. So the whole need to buy in a capital city argument is thrown out the window with a place like Jindabyne. With a place like Fairy Meadow, which is a suburb of Wollongong, 7.7%, only 7,000 in the suburb. Coffs Harbour, 73,000 people, 8.3 annual growth. So we look at our strategy and say, what suits me? Don't just go and buy where you're comfortable or what you know or where you visit on holiday or what you can afford, because there's so many other factors that come into play there. Surya says, what's the ideal population size? Population size, sorry. Well, this is an example that you just need to understand that there's growth in areas that have appeal. Now, I've always stuck to the top 30 cities by population, right? Which is generally anything over about 40 to 50,000 people. But I look at what's the population doing in areas? Is it growing? Is it staying still, or is it going backwards? how much money a government's putting into these certain areas. Now, Jindabyne ideally is too small for me, but they've had the growth. Someone's made some good money out of that. Yeah, so understanding again your risk profile and the real dynamics of what makes a good investment for you, not just a good investment that sits on the front page of the Sydney Morning Herald. So I just thought it was an interesting one to show you, just to look at some certain indicators for certain areas and to broaden your horizons on, well, yeah, okay, this is good for this type of strategy. This is good for this price point. This is good for this growth rate, but I can't afford it because my lending doesn't go up that high, or I can't sleep at night with buying an 800K property in Jindabyne, for example. TX, I wouldn't invest in place less than 30,000. Yeah, so that's just that's a rule that you might have, TX, and that's absolutely fine. Yeah, don't just look at your backyard only, would be my thoughts. Sarah, what free resources are the most accurate with this info? Gross yield and vacancies. SQM Research is probably the one to go for vacancy rates. And they will have gross yields as well. But yeah, there are quite a number of markets to look around. All right, 8-point strategy. Let's delve deep into this. Geez, I've 45 minutes in. Okay, so I won't go fast through this, but I will understand and explain each of these points. But just know that there's a lot more expanding needed to be done, which is cool. And that's obviously when you do a free webinar for an hour, you try to jam as much in as you can. Okay, so I said at the start, realestate.com is the last step in creating a strategy, not the first. So let's look at these. No particular order, by the way. We've got to look at what is our strategy. Is it capital growth? Is it cash flow? Is it tax benefits? Is it a combination of all three? How heavily weighted are all of those three? Do we just focus on one? Now, I personally would never just go and buy property for tax benefits. It's a nice byproduct of it, but understanding what your taxable income is and how you can impact that is also important, and that's where a good accountant comes into play. So we need to understand what that is for you. Now, most of us would say, I'm going to go for capital growth, John. Well, that's great, but that's the biggest thing out of our control. Can we handle the cash flow of the property? Now, if someone said to me, where's the best place in Australia to buy? I would just pouring as rain here. I don't know if you can hear that. Sorry. Where's the best place to buy in Australia? Bondi, right? Everyone wants to live there. Everyone wants to rent there if they can't afford to buy there, but not many people can afford, but the money just keeps rolling in from a growth point of view. It doesn't matter whether it's a studio, apartment, unit, house, you name it, okay? But the cash flow is terrible, right? You buy something there for $4 million, it rents out for $2,000 a week, it's going to cost you 50 grand a year to hold, but it might go up 100. So some areas just don't relate to us. So we've got to understand what is our strategy. The class of property. Is it growth, balanced, or income? Basically, income meaning, do I need an asset that's going to help me in retirement or help prop up my income while I'm working? Do I want a balanced asset that's got a nice balance of growth and cash flow? That's generally a property in middle suburbia. The income asset is generally further out from town, or is a smaller dwelling with less land component that gives you the greater cash flow. Or do you want a growth asset, which is really that blue chip? So class of property, we've really got blue chip. We've got what I call meat and potatoes, which is balanced. And then we've got maybe a reno flip high cash flow sort of deal. The third point to consider is the type of property. Now, when we look at the type of property, generally you start with the statement that says land goes up in value, the building depreciates in value, goes down. Right. So if you take that into this conversation, 9 times out of 10 you'll buy a house. a house that's on its own title with land component, right? However, that will come at a cost, and it may come at the detriment of your cash flow. So just understand the balance between that. And that might mean a larger regional town versus going into a city and buying a 2-bedroom unit. But looking at vacancy rates, looking at the performance over the last 20 years, looking at how many's in the complex, looking at what's the owner-occupier rate in the street or in the complex itself. Okay, so there's so many questions to ask in relation to type. Do I want new? Do I want old? Do I want to do a renovation on it? Do I want to not touch it for the next 12 years and get on with my life? Questions that we ask of ourselves, and then questions that we ask of the suburb or the location. And then indeed the location itself. Which town or city around Australia? Now, I just gave you 8 there before to pick from, and they're just all New South Wales. So there are many options as to where we can buy and invest in. We just need to shortlist it based on what our particular strategy might be, right? But one thing that I would say is don't limit yourself just because you can't drive there. And it's not around the corner and you can't see it, the lawns are mowed, etc., or you've never visited there before. We're looking at the research and the numbers and the logic behind it more so than we are emotionally. I would never live in that house. I would never live in that town. I've categorically made the most money from a investment in an area that I'd absolutely never live. I would never tell my kids to live there. I'm not comfortable even going there, to be honest. But I knew the logic behind the numbers and the research that I'd made before I purchased that property. Loan to value ratio. We need to know what we're putting in, cash or equity. Are we putting in a 5%, 10%, 20%? Are we using a parental guarantor if we're buying our owner-occupier home, or we interest only, we principal and interest? All these things we need to answer in consultation with our mortgage broker. So really important to nail that. And a good example of that is, right, I've got 200K. I can go and put down a 20% deposit on a 600K property, that's 120K, or I can put in 60K, 10% deposit, and leave the other 100K for another property, or my principal place of residence that I'm going to buy in 5 years because I've done some future planning around that. Number 6 is entity, personal name, self-managed super fund, company or trust, as I mentioned before. Go into detail with your accountant around this. Most common is definitely our personal name because that's where we get the tax benefits and it's easier for lending and it's pretty straightforward. However, your situation might be different. You might be open to litigation in your occupation. So that might demand a trust. You might be doing a mini development, which means you're moving it on in the next 12 months or 2 years. You want to distribute some income. So that, again, might be a trust structure. You might say, well, I'm a property mogul and I've got property in my personal name and I've exhausted that. Now I'm going to set up a self-managed super fund. Glenn and I spoke about that on the My Motor Money podcast last week. I think it dropped maybe even yesterday. And the whole, do we buy in a self-managed super fund? Like, personally, not for me, but I know a lot of investors that do it. I think generally you'd start with looking at what your balance is now and how much diversification you've got from property and other assets, and you're probably looking at minimum 200K in there before you'd even contemplate it, because the lending criteria is different, the interest rates are much higher deposits, etc., etc. The 7th one is price point. So what will the banks lend me, and what is the max price that I'm actually comfortable with in relation to my strategy, my class, my type of property, my location, my gross yield? I need to understand that they all marry into each other. And there's potentially not one of these 8 that trumps another. Potentially the only one might be the strategy overall that trumps the others. But all of these others need to be in conjunction with each other. And hopefully you're understanding what I'm saying here. We're not going to realestate.com to find a property or a location that fits my price point, because there's so many more options available to us that we need to think about before we choose that particular location. We might shortlist the location to maybe 3 or 5 locations, and then keep the search open for those, and then reel it into one once we're really comfortable that that's going to be the one for us. And the last one is our gross yield. So what's my rent versus my purchase price is the high level. And gross yield calculation, rent per week times 52 weeks in the year divided by your purchase price times by 100 to get a percentage. And that will give the look at, okay, that's my high level gross yield. Now let's look at our net yield, which is indeed your personal life. What's your taxable income? Are there any depreciation from that particular property? How old is the property? What are the interest rates? What are the holding costs? Have I got strata? Have I got body corporate? Have I got council rates? Have I got property management fees? All factored in to create a net yield outcome, which is that before tax and after tax position that you need to know long before you buy, not once the property settles. Oh, I better find out what this property is doing cash flow wise. Robbie, what's the name of the research site for the property suburb data? SQM research, 2 words. It's free, has some free data, also has some paid data as well, but that should get you by. And yeah, RP Data Core Logic is a paid, I suppose, Rolls-Royce version, but that can get you in and concentrating on a bit of data in the meantime. Okay. All right. So there's the 8 points to consider. Couple of questions that have been building up. First one is, Satrina, are there any benefits of buying a unit with body corporate fees? Does it make managing the property easier? I wouldn't say make it easier. You would generally have a property manager that manages them for you. If you want to manage the property yourself, that's a different ballgame. That's not one that personally I would entertain. Sometimes body corporate fees are a good thing in the sense that things are getting done and maintenance is adhered to and it's kept in good nick. Other times it can be spent in the wrong areas and it can be the sinking fund can be too low, and then all of a sudden you have to put more money in. And so, yeah, there's pros and cons of having body corporate, and it's not just you making the decision. It might be 8 others in the complex or 80 that all have to agree on something as well. So it can be, I would say, more complicated than easy in that sense. But yeah, depends again on what your strategy is, Satrina. Shannon, total purchase price inclusive of stamps, conveyancing and buyer's agent when calculating gross yield. You're saying, do we include that? I think, yeah. When I calculate gross yield, I just get a quick 10-second calculation. Rent per week times 52 weeks in the year divided by your purchase price times by 100 gives me a percentage. That's my starting high-level point. And then from there, I'm calculating the running costs. I don't include the purchasing costs of stamps, conveyancing, and buyer's agent fees. That's a cost of doing business. That's the cost that we would take off the sale price when we sell it, right? So we can't claim that in the year that we purchase, but we can add it to the cost base of the property when we sell it. So that does that help? I hope I've answered that okay. Yeah, if you include your stamps, your conveyancing, and your fees in that, it makes your gross yield look a bit different in a negative way. Okay, every housing market's had growth. Where to from here? I think I've spoken about that in respect to understanding the different markets and the growth that they've had. But looking forward, how do we understand, well, what parameters do we need to find a strategy that works for us, but also then a location that works for us? And I'm banging on about location because generally that's the most important thing for people. Whereas I just use location as one part of that 8-point strategy for individuals. Now, these are some things, some tips and tricks, and they're free, that we look at in our business when we're running a buyer's agent group for clients, finding property around the country. We look at some of these things. Not limited to, but definitely factored in. What's the 20-year historical growth showing? Now, I will premise that sometimes we have to pay for data to get the accurate data, right? So the SQM research piece, yeah, that's free. Census data, yes, that's free. But if we really want the accurate stats and go to that next level, paid subscriptions, unfortunately, is where it's at. Is the population growing or slowing? So when I look at the 20-year historical growth, I look at what's it been averaged out over 20 years, but also how many positive years of growth has there been in that period versus how many negative years of growth. And one might find that you might have a mining town, for example, it's gone up 500% in 10 years, but it might have been 3 years out of those 10 that were astronomical growth, and the other 7 at either plateaued or negative or just stayed still, So for me, that's too high speculative. I'm not putting my hard-earned money into something that's 3 years out of 10 has good years and the other 7 are no good. Okay, so looking at those trends. Population is an important one. If population isn't growing or isn't stable and not decreasing, or if it is decreasing, they need less homes to basically manage that. So that puts my dwelling at risk. What's the vacancy rate showing over 20 years, not just 20 minutes, right? Really important. Someone says to me, oh, the vacancy rate's 0.4%. Yeah, but it might have been 7% 6 years ago. Why was it at 7%? Is the government spending money in the area? If the government is spending money, generally they're the one of the wealthiest institutions in the country, other than banks and mining magnates. So if they're putting money there, they're putting it for a reason. So they're usually putting money into to grow economies. They're usually putting money there to improve infrastructure, and they're always doing it because population's increasing and they're trying to keep up with that. What's the economy diversification like, right? So a really key one there is you can look at it on the census data. You can see what the top occupation is in that particular suburban town, and what is it. So it might be professionals at 15% of the economy is the leading particular occupation in that town. So that's fine, versus another town that might be 35% agriculture. Now that's a little bit more of a risk because it's heavily dominated towards agriculture in the event of a drought, or it might be mining. So then when the mines are down, the whole town's down. This is a good one. Well, they're all good ones, but this one in particular. What percentage of homes are owner outright, and what's the percentage of investors? So why do we want to know how many homes are owned outright? Well, take 12 months, for example. We've had 2% interest rates. Now we've got 6% interest rates. If 40% of the suburb or the town have their homes owned outright, they haven't missed a beat in the last 12 months. They haven't even worried about the interest rate. They probably don't even know what the interest rate is because they don't have a mortgage, right? So they're safe when it comes to recessions and losing jobs and interest rate hikes and all these things, which generally means the majority of the suburbs going to stay stable and is not going to dip in value by any drastic measures, okay? And then conversely, the percentage of investors, which usually if the owner-occupier outright is high, then the percentage of investors will be pretty well in check. And then what's the average household income in comparison to the median house price? Just gives you an idea that, okay, majority of people in the town or the suburb can handle a mortgage at the current rate that it's looking at. And median house price is obviously a guide. So it's, again, a starting point, then you can delve deeper from there. So that's not a bad list to start with. And everyone has their own ways of doing research around different areas. But there's some of the stats that I would want in front of me before choosing a certain area. All right, we're already over time, so I'm wary that I don't want to keep you too long. So growth versus cash, basically saying, do I want capital growth? Do I want cash flow? Which one's more important? How long am I into my investing journey, and how close am I to my retirement age or transition period, as you want to call it? Most investors, they go for growth without appreciating the cash, and that's set up for disaster. But then really understanding what your strategy is. Do you want to mix of both? Do you want to focus heavily on one or the other? What's your current life situation like? What's the next 5 to 10 years? All culminating everything that we've spoken about right from the start through to now, when we're devising that strategy before we execute. And this thing, I don't mean it to scare you, is just understanding the life stage cycle. So if you're sitting there nice and young and energetic and ready to take the world by storm, I love that. That's fantastic. Understand that you may want some of this, whether that be getting married, whether that be having children and growing a family, and just understand that may be a 20 to 30 year period. So if it is a 20, 30 year period, don't lose sight of investing and building your wealth through that period. Too many people I've seen come out the other side of that at 55 and 60 and say, yeah, I'm ready to retire. And they haven't got enough because they haven't done any investing in that 20-year period of bringing the kids up, because they focus mentally, physically, financially on doing exactly that. I can't blame them for that, but don't lose sight of being able to invest. And that's generally just saying, well, have I got equity here? Yes, I have. How much can I lend? Away I go. Whoop. So how's it all look like at the end? These are really the main options, and the 6 of them that I won't get to go in detail tonight, but keep all the properties, not paying down any debt other than like your principal and interest, and just keeping the properties because you've got super in retirement to live off, and then pass that on to the next generation. Keeping all properties but paying down your debt. So maybe some other assets in your life have able to pay down those properties. Keeping all the properties and increasing your debt, which is an interesting concept. It's basically saying, well, I'm going to buy more properties shortly before retirement so that I can build my portfolio long after I'm gone. And then the last 3 is selling. So sell down part of your portfolio to pay down all of your debt and live off the cash flow. Selling part of the portfolio and living off the profit, or selling the whole portfolio and having some fun with it. Basically saying, look, I've done 20 years of investing. I've had 5 properties. I've sold them all. I've taken $1 million or 2 million or whatever it is, and I'm going to enjoy it and spend every last cent before I go. So no one size fits all, but having a think about what it might mean for you, and checking in every 12 months on your goals and outcomes are really important in devising this, because this may change over time as well. The old Warren Buffett quote, when others show fear, I show courage. Others show courage, I show fear. So at the moment, there's a lot of fear coming on. Those that have got the courage to take action at the moment, I think will reward themselves nicely in the coming years. Those that wait for a massive downturn and oversupply, in a lot of cases, I think might be waiting a long while, just purely because supply and demand. All right, so I'm going to round it there, and then I'll go on to my hard sales pitch. Not really. What have I learned? What do I need to change? What are my next steps? So understand those 3 questions and spend some time. Might be just 15 minutes, half an hour tonight, tomorrow, the next night, weekend. What are my takeaways? What am I going to or need to change? And what are my next steps? If I've came here to educate myself, hopefully I've got that or some of it tonight. But understanding what your action steps are. Doesn't matter what you do in life, you should always have action steps ready to go, so that you build momentum. Because if we're standing still, essentially we are going backwards. All right, so here we go. QR codes. And I've got a couple of polls as well, which I'll run through in a minute. I've never offered this before, and you people are the first to potentially take advantage of this. If you want a free 15-minute chat, and yes, this has been free for an hour and I've chatted, but you haven't, take a photo of the QR code on the left and we will have a 15-minute chat. It'll be a hard 15 minutes. It won't be 16. And it'll go through, it might have some little roadblocks. You might have, some confusion around the world and what's happening. What do I do next? You might be singing out to say, yep, I need your buyer's agent service, or I need your property coaching, or I need some tools, but I'm not sure what it is and how it works and whatever. I might be answering some questions there, but 15 minutes, click the QR code and we'll organise a chat there as well. We've got some online property masterclasses. We've never bundled them before, beginner and advanced, so you can take a grab of that, and that's a special discount that I don't know if it'll be offered again, but it's definitely here for a limited time for you guys for coming out tonight. And this one I'm excited about. We are launching an online property coach. So some of you may know, we do a 12-month property individual one-on-one coaching course, which allows you to take action, but I shoulder you and give you education and action steps and away you go and buy your own property. It's pretty cool. Some people just not in their right frame of mind or time in life to outlay that sort of money. So we've created an online property coach, which is basically a truckload of my video content, my tools, my resources, and away we go. Now, we haven't confirmed what the price will be per month, but it'll be like a Netflix sort of subscription thing, and you can go to town on a whole heap of education. Interested to know in the chat group, if you're still around, who would be interested in something like that, because it's probably going to launch in the next month or two. It's going to happen anyway, but I'd just be interested to see who. Just put up your hand or say yep or whatever, or just say no if you don't. But yeah, I just think it's something that's long overdue. Been meaning to put it together because I'm all for affordability. I'm all for people accessing good, solid information, and I don't want people going out there with the wrong knowledge in the world and buggerizing it up. So yeah, so pretty keen to get that out pretty soon. Okay, cool. There's a heap of interest there. That is awesome. Thank you. Will it come by an app? No, Ivan. Sorry, it won't have an app. It'll be your own username login though. You'll have your own. You can log on and do your own thing. The real life coaching cost, Leah, is at the minute $7,500 for 12 months. So yeah, look, I think again, going back to what would I do right now, first starting out, every day of the week, I reckon I spent 30 grand on weekend workshops, paid webinars, like people in person, like the amount of things I went to over a good 15 years would easily have been 30, 40, 50K. Yes, it's helped me along the journey, but I did it the hard way. I would definitely fast track it if I was starting again. Is the difference between masterclass and property coach? Yes, there is. Yes. So the online masterclasses, that will be an option, but not for the online property coach. Yeah. So that answers your question. They're very different, but all educational nonetheless. All right. So that's pretty much it. I'm really sorry that I've gone over 15 minutes, but I did actually have some polls. Let's run one now, hey? Let's launch it. Who's able to purchase an investment property in 2023? Just quickly give me an answer. Just keen to see what people are doing out there. Yes, no, try my best. I could, but I am not. are the options there. Pretty cool watching that poll just go forward and backwards and sideways. So 46% saying yes, 27 no, 15 saying try my best, 12% saying I could but I'm not. Cool, okay. And we'll end it there. That's awesome. So I'd end up with 45% saying yes. Great. Nice work. And one more, because I know you love polls. Oh, I'll share the results here. There you go. You should be able to see those. And thanks, Shannon. Yeah. Now one more poll for us. Let's do this one. Shit, won't let me do it. I was asking the question, what are roadblocks preventing you from taking action? Mine is my IT skills. Is it lending, deposit? Is it fear? Is it risk profile? Or is it something else? If you just want to put that in the chat, that would be good. It's just interesting to see. Yeah, lending's a common one, isn't it? Yeah. There's some fear there. Deposit, yeah. Rates, okay, yeah. So rates meaning servicing, I imagine. Yeah. No buyer's agent, yeah, or James, you know where to come. We can help you out there. Deposit cash flow, got to find a builder. Servicing, stability routine, fear commitment. Okay, the fear commitment thing is very much education. You overcome that, I guarantee you, because I've taught people how to do that. It's not hard, but it's not easy, but it can be done. But education is power, and I think it just gives you the ability to do anything once you've got it. And just finishing, education is one thing, and you can tell I'm passionate about it, but education is one thing, unless you get dementia, that it cannot be taken from you, right? You can do whatever you want in this world, but if you have education and you have knowledge around something, whether it be your employment or your property investing or share investing or whatever it is, AFL coach, right? Once you've got that knowledge, that is power for you, but then to implore onto others. And for me, it was about giving it to my kids as well. So my 14-year-old looks at real estate as we're driving and says, well, that's a good size block, Dad, can we subdivide it? Right. Now it's just, I get hair goosebumps when he says that stuff. So it's just, I implore you to just educate yourself. Don't rely on others to do it for you, but I agree that some may want to outsource it. TX, what's your buyer's agent fee? Well, that's a good question, and that reminds me, our price is going up July 1. So in the next fortnight, it's what is it? 13 grand for the full package. I think it's going up to 13.5, I'm told. And we have a BA package 1, which is pretty cool. It's sort of holding your hand, but you're doing the search. We set the strategy and then we negotiate at the end. That is 7,500. So a lot cheaper, but you're doing a lot more of the heavy lifting, and a lot are choosing that because they've got the lack of funds. They can't pay for a buyer's agent, but they appreciate the support and comfort in knowing that they've got someone in their corner right from start to finish. Cool. What else? Joshua, where's the best place to start educating yourself? Just right here. No, look, there's so much online material, isn't it? And there's actually too much, I reckon. I would just listen to podcasts. I would read books as much as I can, and just so much. Yeah, just talk to good people. Talk to people that have done it before you. Not someone that's just start up a business that I'm just a property coach or I'm a buyer's agent just to make some money. They've got to have runs on the board. I think you've got to get. They say it everywhere, don't they? You employ someone or get someone in your corner that's been where you want to go, and that's absolutely the best. Hi Kira. You want to be a buyer's agent, don't you? What books do you recommend, Luke? I'm going to get shot for not being home by now. Yes, books. I would start with Rich Dad Poor Dad, Cash Flow Quadrant. I'm actually writing a book. I haven't told many people this. It's coming out next year. Who would like it? I don't know. I don't know who would like it, but what else? What other books? Look, I wasn't picking and choosing when I first started reading property books. I think, yes, absolutely. I just read them all, and I'd take good bits and bad bits and other bits and just apply it, like not apply it, but just bring it um, into my kit and just use it and apply it as I think. Because there's no, like some people say, oh, off the plan apartments, no good, brand new, no good. Like I've made money from both of those. Right. So it's not that the concept is bad. It's just that people make the wrong choices within those types of investments, right? They don't do their research. So don't dismiss something. Don't dismiss a book because of its heading or some of the concept in there or the person writing it or whatever. Just soak it all up and just continue to read. Consistency is key every day, every week. So yeah. Someone asked for my details. Annette, I don't think it'll have my humour in it, to be honest. I'm not that funny. Yeah. Oh yes, very smart, Mitch. Yeah, I did spot the career book yesterday. Yeah, so where's my details? Here somewhere, aren't they? Yep, jump on these two websites. Solvay Wealth is our coaching for those who haven't been on there before, and Envisage Property is our buyer's agent. So, yeah, check those out, and that will have a link, an inquiry form. Just say you listen to the webinar, and that you want to have a chat. But yeah, that free 15-minute chat, click through to that, and we will be chatting anyway if that's you. All right, I better get home. Thanks for joining us. Really appreciate it. It's been great to have this one-way conversation. And if there's, yeah, I look forward to working with some of you soon. If I never see or hear from you again, it means I've done my job. So I'm happy with that as well. So appreciate you guys tuning in. And until next time, we'll chat soon.